Alright, good evening. So to continue our session, let's talk about stop loss and take profit. So managing and preserving your capital is the most important thing as a trader. So your stop loss and take profit basically plays the role of your risk to reward ratio, if that makes sense. Now the name says all for these two functions. The stop loss stops your loss and the take profit takes your profit. So but both of these options work automatically as stated right over here. So a stop loss acts as a safety belt for your funds, and then take profit acts as a net to catch your profits. So look at the example over here. This is a stop loss example. Now, say we enter a trade, we look at price, and we see price is trading up over here. Now this is as I explained in the previous video. If price goes up to this point, this is the resistance. Now price breaks above and then retest. Now resistance becomes support, and let's say we buy the support and then we go up into profit, right? Now your stop loss would go below your buy, as you know, because if you're buying, you expect price to go up, and if it goes below, obviously you want something to stop your loss, right? Makes sense. And vice versa, if you look at the other side, if you sell, your stop loss goes above your entry. So if you are selling and you expect price to go up, I mean you expect price to go down. If it goes up, you want something to stop your loss, right? Makes sense. Now a stop loss can also have a different um, function. It doesn't necessarily only have to stop you from losing money in the sense of catching your losses. You can also use your stop loss to take your profit. Now, being in a losing position is inevitable, but what we can control is what we do when we put in a situation like that. So you can either cut your loss quickly, or you can ride it out in hopes that the market goes back into your favor. But this is why if you set a stop loss, it should always be a calculated risk. Alright, so you shouldn't feel some type of way if you stop loss. You shouldn't feel emotional or whatever the case. So having a good trade on a however, on a good trade, a stop loss can eventually be used as a tool to lock your profit. So like I said, if you're selling, your stop loss goes above your entry point, right? So let's say this was your sell. Now let's say you see price goes into profit immediately, and you see your pullback, and for some reason you see that price correlates with this over here and price holds, and you see price dropping all the way down. Then you can actually move your stop loss into profit. So then if price for example comes all the way back up and it hits this point, then all the profit you've made from here on will still be in your pocket, right? Hence we say that so the other word you can use for this is called a trailing stop. Now same thing, if you are buying, your stop loss goes below your entry, and same as I explained in the other position. If you're buying and price goes all the way up and you see for some reason after your pullback the price holds and price has a strong push again, you can then still also move your stop loss into profit. And in the case that price comes back and goes to your stop loss, you can still be stopped out with some money. Now a take profit works a little bit different, but whenever price reaches your TP, your target zone set, this function should automatically take you out of the trade, securing your profit, as the name says, take profit. So for example, let's say you buy over here at the support, stop loss below. So as you can see over here, more or less what I mean by stop loss and take profit. Look at the point of the entry right over here, and notice the distance of the stop loss and the take profit. See the stop loss can fit in here more or less 3-4 times. Hence your stop loss should never be bigger than your take profit. It only makes sense, right? So in the next example as well, as you can see, if you're selling, your take profit should be below your entry, and like I said, if we're buying, take profit should be above that zone. Take profit is pretty simple, you know. Once you set it, you just wait for price to hit it. It should get to the point where you should be surprised after taking a trade if price hits your stop loss, you know. So I want you to become that good at trading that you only hit your take profits. Now I also want you to remember one thing: that price will not always hit your take profits. Sometimes market will deliberately hold price away from the TP in order for them in order for you not to make you money as they intended. Now this is called manipulation, right? So sometimes you must not be greedy and just take your profit and walk away. So the next thing I want to talk about is the order types. So we have 5 types of orders in the market. The most commonly used one is a market execution order, and this is when you buy at current market price. So with some brokers it's also called instant execution, but be mindful that if you trade with a broker with instant execution, that your orders might be delayed and sometimes might also be rejected, because market execution is a faster technique of executing an order, if that makes sense. So it also depends on your broker. So basically a market order is a buy or sell order at the best available price. If you click buy and sell on your trading platform, it would instantly buy or sell at that exact price, hopefully. Now we also have pending orders: a buy limit, a buy stop, a sell limit, and a sell stop. And how that works is a buy limit order is placed either to buy below the current market price or to sell above the current market price. And this is a order that only activates once market reaches the limit. That makes sense. So if you place a buy limit, the order goes below the current price, and if you place a sell limit, the order goes above the current price. So for example, the blue dot on this picture is the current market price. If you place a buy limit, price goes below the current price, and if you have a sell limit, price goes above the current price. Now let me make an example of this real quick. Say price is trading right over here, right? It's going sideways, and you expect price to buy. Now initially, say price holds on the support. Now a lot of people would buy there, but if you know, according to what we teach with the stop hunts and so forth, if price must first hit a certain level, and you don't want to wait for it, you can literally place a pending order and at this current price of here, when market is still here, and when market initially goes to that point, it will automatically take you into the trade and then go in the direction you are hoping for. So this is called a buy limit. And a sell limit works the same, only in the opposite direction. So say for example you have a resistance zone and you see price is trading, right? But you expect price to first go all the way up a little bit more and then sell. You then place a sell limit at that zone, and then when market reaches it, it will automatically take you into the trade, right? Makes sense. Very simple. The next type of order we have is a buy stop. Now a stop order is usually an order that executed once price reaches the stop price. So basically you would use a stop order when you want to buy after price, let me put it this way. You would use a buy or sell stop, or let me put it so you would use a buy stop only when you want to buy after the price rises to a certain point, and you would use a sell stop to only when the market sells at a certain point. So then same thing, as a buy stop goes above the current market order, and a sell stop goes below the current market order, the current market price. Now an example over here, once again the blue dot is the current market price, and the buy stop, as you can see, price goes up. The yellow line, the green line is the pending order. So when you expect price to go all the way up but you're not sure when, then you just place a pending order after that, and when price reaches it, it should take you into the trade automatically and you ride the wave. So let me draw an example of this real quick. So say for example price is consolidating, right, and you know that once price, for example, breaks this point, it's gonna go all the way up. So you then place a buy. So if you're gonna place a buy stop at that point, when price breaks out of this zone, for example, and it gets there, it takes you into the trade, and when price moves, you into profit with the move. And same thing with a sell. Say price is trading within a zone, right, and you know that once price breaks below this point, it's gonna go all the way down, and then place a sell stop, and then price goes, it activates, and then it should go all the way down, right? Makes sense. So then next time let's talk about is just some more knowledge trading styles. So there's three types of traders, scalpers, intraday, and swing traders. So scalpers are those who trade in small time frames with big lot sizes, getting in and out of positions very quickly, grabbing 10 to 30 pips per trade, and that's usually taking on the M5 or on the M1 charts. And then you have intraday traders, people like me, for example, who trade on the medium term time frames, and mostly in most cases will only hold a trade for a few hours, but not more than 24 hours. Trades are taken place in the M15 and the 1 hour time frames, and then swing traders are those who hold positions for weeks, months, even years, with trades based on the daily, weekly, and the monthly time frames. So as a trader, you need to define what style works for you the best and implement your trading strategy for your suitable time frame. For example, if you work very long hours, I would suggest swing trading. Maybe taking 2 3 trades a week, and then say for example, if you're a scalper and you want to take 10 trades a day, that's on you. I prefer taking 2 trades a day. That makes me feel like I'm constantly involved in the market, while also upping my trading skills, so but you have to find what works for you as a trader. So the next time I want to talk about then is indicators. That's going to be on platform. So indicators are used by traders on a regular basis to increase their chances of making a profit. So those of you who study PTMM would know that we use the EMAs, market the moving averages. So then as traders, we examine the data on the market based on previous moves, and indicators are one way examining the market data automatically, if that makes sense. So all indicators should also have settings to change their values in order to measure data based on a certain mathematical sequence or equation. So then by examining the historical data such as currency, price, volume, and market performance, indicators seek to predict how the market will behave in the future and what future patterns might likely be repeated. Now this is where most traders make their mistakes by following strictly indicators. Indicators is based on previous market data, so like you can't necessarily act on the past if you have to predict, if you have to react in the moment. I hope it makes sense. So the best indicators of Forex work on the assumption that past patterns are likely to repeat themselves, providing a similar circumstance to provide, which is kind of true. In the market, history doesn't repeat itself, it kind of rhymes. So um, as a trader also, you will see in the next video I will be dropping, I'll be talking about your signature trade. So you'll be able to spot like this pattern pays me, for example. And once you master that pattern, you only start looking for that pattern. But there's a lot of things which can be implemented with your indicators to up your profitability. So it's important to also know at Pharo Markets, we don't use indicators for entries, but we use them as a guide. And that's also what we'll be teaching as we go on with our lessons. Now, one of the other things I want us to talk about, like I said, is just some more knowledge. Technical analysis is basically it's also called price action, and technical analysis is basically only studying the historical price in order to identify patterns and probabilities for future movements. So technical analysis also focus on price on the chart to identify the trend, support, resistance, and the momentum, to help us get in and out of trades. So a technical analyst believes that price moves in trends. Price movements are generally followed to establish price patterns, and also there's some psychology which comes with it, with the herd mentality, and a lot of people who follow a lot of trades based on hot stocks and things like that. So market reacts very similar in certain situations based on certain conditions. But the main theory of technical analysis is recent price allows you to understand where buyers and sellers in the market are thinking. You can either then tell whether it's buying or selling based on the momentum, and also allows you to basically predict what the market makers might do next. Now the fundamental analysis is much more interesting and much more fun in my opinions, because it's a way of more logically looking at the market, in the sense of like analyzing the economic, social, and political forces that may actually affect currency prices. For example, we saw what the war in Ukraine did to the gold price, or so. So world leaders also have an effect on on market prices. This is why it's important to keep track of news events and news releases every week, as they can be the drivers of the market, stop hands, and also hidden moves for the market makers. So investing.com is a very good app that I use, so I see all the news events for the upcoming week beforehand, so it gives me time to prepare. If you guys want, I'll send you guys some screenshots and you guys can download it. So you have to understand the reasons why and how certain events have an increase on the market. For example, how unemployment affects the economy and things like that. So there's a lot of things which actually has an effect in the market, and if you can spot it, you can make a profit on that. So the better the shape of a country's economy is, the more foreign business and investors will invest in that country. So also this is where you can start spotting opportunities like a real trade on Wall Street. So when when a news event is released, right, the market can move up to 100 to 500 pips in seconds. It can do in a second what the market does in a week. So like it's very risky, for example, when you trade fundamental events, but if you can determine direction, you can make a lot of money. So the last thing then I'm going to talk about is leverage, and leverage can also be so this is also where making so much money comes in with trading, right? So the technical definition of leverage is having the ability to control a large amount of money using none or very little of your own money and borrowing the risk. For example, to control $100,000 position on your broker will set aside $1,000 from your account, and your leverage increase ratios is now 100 to 1. So let's say your investment rises. So let's say you have an investment of $100,000, right, and it rises to 101, or it only makes $1,000, then you've only made a 1% gain on your account. But think about it, like for example, if you made $100,000 from $1,000, the percentage gain. So leverage can be to your advantage, but it can also be a double-edged sword. But this is why it must be very important to you how you use it, and how you must also understand how this affects your margin costs. So your margin is basically the cost of placing a position like that. That's why it's very important to understand how to manage your risk. And if trading with a small account, it's recommended to stay away from pairs with a very high margin cost. For example, like the Turkish lira and things like that. So this is where the term margin call comes from, taking a position with such a high margin that your equity / your free margin has no room to ride. So when this happens, this is usually very bad for your account, because you could then blow your account. So say for example, you take a trade on US 100 Nasdaq, and you have a $150 account, and we buy with a 0.0 lot size, and the margin is $50. Your balance will be $150 equal to $150. Your free margin will then be $100, because remember the margin is $50, right? So the market maker takes the money from your account, because that's the cost that you're paying to take the trade, and then okay, I made a mistake here on margin. It should be $50, so you can kind of see the math that takes place over here, right? So then your equity is the thing that as the market fluctuates, right? So let's say you enter that trade, then automatically going to be in, let's say, minus 50 cents, minus $1, it's going to fluctuate. Now as it fluctuates, your equity will fluctuate. Now let's say you're in minus $1, your equity will then become $149. If you make $10, your equity will become $160. So basically your equity, if you have running trades, your equity is what your balance will be after you close all the trades. I hope it makes sense. So then if your position goes from minus $100, for example, into a loss, your account will go into a margin call and look like the following. So then your balance will be $150, equity $50, free margin 0, your margin 50, and the moment you go below 0 on your free margin, you then have the potential of losing all that money or blowing your account. Right, so it's very important to always have your free margin open. So for example, not gonna type anything, but say for example you trade Nasdaq, a quick trade, the margin for 0.0 and lot size is 43 rand. So if you trade with 1,000 rand there, then you have like a 950 rand free margin. So it's kind of impossible for the account to blow. Does this make sense? So yeah, I hope this made sense. If you guys have any questions, just hit me up. Like I said, there's a lot of basics. Just some things you guys should understand and should know. But let's get into the more advanced things.